Welcome to the May 2025 monthly motor checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist and Portfolio Manager here at Motor Capital Management and Research. The name of the video this month is The Great Shell Game. This is something that I've been talking quite a bit about, but it's just getting more and more important, so we're going to spend a video on it. Before we jump in, let's just quickly take a look at the very important disclosures as we do each month. Many of my readers will know and clients will know that I believe strongly that the market hides the truth when we need to hear it the most, and this is often at major turning points. So the S&P, for example, is up more than 20% and has retraced more than 75% of its February to April slide. This is leading many to believe that the worst is behind us, of course. Perhaps they're right, but what we're thinking is that they're looking underneath the wrong shell in this great shell game that we talk about. The truth is under the breadth shell. So this is the market from 2023 to present. And what we've been talking about quite a bit in our notes is how the market had become increasingly divergent into the high, and ultimately, as things really deteriorated in February, our monthly video then was titled Rut Raggy, which was our inflection point in our research to indicate that a short opportunity was coming up. So this divergent environment is what was in place adequately enough to get us to be short for April. And now we're looking at this massive rally across the range, more than 75% retracement. And once again, this is leading most to believe that the worst is behind us. The point is that you'll see this is common behavior prior to the actual meat of the bear market. So this is sort of like a head fake. This is the shell game. The market wants you to watch the shell that is the S&P 500 because that's the one that it wants to use to get you to think things are fine. But what I want to demonstrate is that the actual shell you want to pay attention to is breadth in market leadership, in market structure, because when you lift up that shell, you discover that we're still in a bear market. So let's walk through that. So this is the risk gauge, and remember this risk gauge is simply five inviolable inputs, things that have to be true in order for there to be a bull market or for a bear market. All of the inputs are technical, so valuation and sentiment and all those things are not in the risk gauge, and they're not in the risk gauge because they don't always have the same effect on the stock market. So sometimes rising rates are good for stocks, sometimes they're bad, sometimes a rising dollar is good, sometimes it's bad, sometimes the market goes up when the Fed is cutting rates. Sometimes it goes down when the Fed is cutting rates. So all these things are really important, but they're not in the risk gauge because they don't always behave the same in bull and bear markets. So when we look at these inviolable inputs, we want them to be in risk on for us to be fully invested in buying dips in even buying breakouts. Instead, what we have the two long-term time frames in mixed, which means, as you know, if you've been following along in the research, mixed means exactly that: sell overbought and buy oversold. One of the latest innovations that we brought into the risk gauge is that we color the label to indicate in which direction the particular time frame is closest to going. So if the background is red, as you see it is in all three of these, that means that that time frame is closer to ticking down than ticking up. If the font itself is also red, that means it's very close. So in this case here, we see that all three of them are red, and the short term and the long term are red is what we call it. And so all three of them are closer to ticking down than up. And so this is just not a robust breadth bull environment that would be conducive to bull markets. Again, this means that when you get strength, you should sell it, don't buy it. This is what the risk gauge is built to help us understand. What should we do with overbought conditions? What should we do with oversold conditions? Taken together, this tells us that we should sell overbought conditions and buy oversold conditions. And obviously, what this is telling us in the short term is that we're very overbought. And the fact that we've gotten so overbought, in fact, we came from risk off to risk on, and we made that significant move without being able to remove the medium term from the bottom half of mixed, tells you just how broken the environment is. So this is where we are from a market structure perspective. This is just not the ingredients you would have in place, the inviolable ingredients that you would have in place to have a sustainable market. So we are just suspect of any market gains at this point. When you look at market leadership as it stands today, this is something we've been harping on as well. We've had this 20% rally across the range, and yet we are still stuck with very defensive leadership. And when I say very, I mean, for instance, precious metals is number one, telecom is number two, insurance, utilities, hardware is number one, but that's because it's not making excuses. We'll just leave it at that. It is a cyclical group that is leading, and so that's one positive that you can say. But consumer services, media, banks, financial services, and software and services, which is one of the more defensive parts of tech, that's where all your leadership is. So this again is not the type of leadership that's in place when the market is trying to hint or signal that a bull market is coming. All that leadership that we would want to see at the top is down here at the bottom. Metals, materials, oil and gas, transports, alternative energy, chemicals, semiconductors are down here at the bottom, number 25 out of 27. Biotech, consumer durables, these are all the big ticket items, cyclical parts of the consumer sector. They're all at the bottom. So these things should be at the top. This is where they were for the last 3 years. And they began over the past 6 months to slowly work their way down the list, something we had been chronicling all along the way. And so here we are. This is just not leadership for a bull market. So we are very suspect of, again, rallies because it does not have the backing to continue higher. And then we can also say, looking at the structure of the market, again, as you know, we track the risk gauge in three time frames: long term, medium term, and short term. This is price trend in the medium term. So this grid that you see here is a component to this time frame of the risk gauge. And what we can see is, again, we can break trend itself into three buckets. We have uptrend, which looks like this. Then we have an up base, which is an uptrend that goes into a base and it's overbought. And then we have up base minus, which is still a base, but it's oversold. And then eventually that gives way to downtrend. And then that gives way to up base plus and up base minus. And those are the six stages. And the value of knowing that and being able to map all these stocks to these different stages is that we're able to then say, well, where is everything? What stage, or what's the biggest stage, if you will, in the market? And when you look at that today, this is the biggest trend bucket across the market. 38% in the monthly time frame. 38% is the biggest trend bucket. So it looks like this for most charts. And then when you look at all of the charts and you say what percent are in an uptrend, which basically means if you add up all three of these potential uptrend stages, these are the potential uptrend stages, add them all up, and you only get 39%, which means 61% are either looking like this or they're in some sort of a base of a downtrend. And we know exactly what percentage those are across the different groups. So here's the groups, and here is the blue percentage is highlighted blue because it's the biggest trend stage for that group. So probably the most important one to look at is semiconductors. And what we can see is only 15% of the semiconductor space is in an uptrend. Now, it happens to be that the biggest bucket is a down base plus, which is a base of a downtrend that's overbought. But what we'll note is that there are zero trends in the semiconductor space that look like this on the monthly trend. So this is an overbought downtrend. This is a very important group. It's ranked number 25. The S&P has retraced more than 75% of its decline, and this is what we have to show for it. Any group that is showing any modicum of positive price structure, you'll look up here and you'll see that almost all of them are defensive in nature. So the best one is precious metals. 70% of precious metals look like this on the monthly chart. That's great for precious metals, but it's precious metals. But you'll notice that these ranked 6 through 10, they're all defensive. But note this, they're almost all in downtrends. So these are defensive groups that are leading, but they're leading by going down less. This is, as much as we want to think that 75% across the range is a good thing, it's actually only good if that rally can fix things. And as I'm showing you here, it hasn't fixed anything. So all we've done is go from being broken and oversold to broken and overbought. So that's the shell I'm looking at, and I'm by no means am I saying that I'm right. All I'm trying to explain to you is what my process is. And I want to stress this because these are the things that I told you I would be looking for before we rallied. So as you recall, I did look for a rally to 54 to 5600. I later upgraded that to 5800 and then later upgraded it again on the idea that there was such a strong impulsive move on the weekly chart that it's going to take time to kind of distribute and roll it over again. So I just opened up the possibility that we could even go above 5,800. But what I said before the rally even began was that I needed this to get above the top half of mixed. I needed this leadership to get better, and I needed all of this stuff over here to work its way over here. And the value of saying that beforehand is that you can then say when it happens, did any of it happen? And you're not starting to make excuses or change your mind because you want to get bullish. These are the things that are inviolable. These are, and much of what you see here is partly what you see here is what composes the risk gauge. And so I'm not going to turn bullish until the risk gauge tells me to. And it's not that it's super bearish right here, and I think that's a fair point to make, but it's not bullish. And it does have the configuration of what it looks like leading into bear markets. And so the fact that the monthly chart is in the bottom half of mixed, yet the market has retraced 75% of the decline, is basically sitting right at its highs, yet this is still in the bottom half of mixed. That's what's more important. The rally's not important. The only thing that's important about that rally is what did it do? And I'm just saying that it did nothing, at least in my lens. Take this for what it's worth in your mind and how in your process and the decisions you need to make. This is my process. This is how I think about it. And to the extent that you value this input, this is what it's showing. Thanks so much for watching this clip of the monthly motor checkup video. We appreciate your interest in our research, and we hope that you are finding it helpful and informative. If you'd like to continue watching this video as well as access our most recent monthly motor checkup, sign up for a free 30-day trial to all of our research at motorcmr.com. You'll find a link to our website in the description below. As always, like and subscribe to be notified of future content.